This week, I had the pleasure of speaking with none other than Barry Ritholtz, renowned investor, author, and the chairman, co-founder, and chief investment officer of Ritholtz Wealth Management, one of the fastest growing wealth management firms in the United States with $5 billion assets under management. With a career that blends market insight, media, and thoughtful commentary, Barry has become one of the most influential voices in modern finance. Barry is the creator of The Big Picture, a financial markets blog that has amassed over 275 million visitors. He is also the host of the Masters in Business podcast, the first mainstream long-format finance podcast, having hosted guests such as Ray Dalio and Howard Marks. Barry is also an accomplished author, having written Bailout Nation in the new book, How Not to Invest, where he breaks down the most common mistakes investors make and how to avoid them. We spoke about his path from law school to Wall Street, the origins of Ritholtz Wealth Management, key lessons from his new book, and his advice to the next generation of investors. I hope you enjoy. Thank you, Barry, for joining me. I really appreciate it. Thank you for coming.
Oh, thanks so much for having me.
So I want to start your childhood and your upbringing. So tell me a little bit about your childhood. What was it like, and how do you think your kind of upbringing shaped the person you are today?
Sure. A pretty middle-class upbringing. My mom was a real estate agent. My dad started out as a personnel manager, getting jobs for engineers, scientists, people like that. When the company he worked for kind of blew up, when the founder died, he decided to open his own business running a sporting goods and sneakers shop. So I always had the latest, greatest Air Jordans and the like, and wore them before we knew they had any value. Every now and then I'll wear like an old pair of Kobe Dart Frogs, and people will, on the subway, will look at me like, you know what those are worth? I'm like, dude, they're just sneakers. Um, but a pretty normal upbringing. I went to a state school. I was told I'm going to be an engineer because I was good at math and science. And so I did that for a couple of years. Wasn't really my favorite thing, and ultimately switched to political science and philosophy. Didn't know what I really was super enthusiastic about. There were like a lot of things I really liked. And so went to law school and ultimately kind of stumbled ass backwards into Wall Street and finance. A dumb coincidence of having grown up, 45 minutes away from Wall Street.
Yeah. And so your mom was a real estate agent and your father was a placement officer for engineers and scientists, but eventually owned a sporting goods store. So what were each of your parents like, and what traits do you think you kind of inherited from each?
So my father was very logical and rigorous, and my mother was very creative. She had gone to music and art, played the piano, the drums, the saxophone, had a perfect pitch. I could play any song for her and she can immediately play it on the piano. So a little bit of both. You get some of both your parents. My generation was kind of the latchkey generation. Like, forget today's helicopter parents. Like, you kind of learned how to do your own laundry and cook because, hey, they were both working, and if you want something to eat, you better make it yourself. Probably what led me to a love of books and reading and eventually writing. And so, I could spend years and years in therapy whining about my parents, or I could just say, all right, I adapted and made the best of it. All that freedom that I grew up with, that your generation didn't grow up with. Hey, it has its pluses and its minuses, but it meant that, I fell down the rabbit hole of Tolkien and Heinlein and science fiction, and nobody told me, go do your homework. It's like, I'm reading The Hobbit for the fourth time. I'll get to calculus eventually.
I love that. And so you went to law school, which is not the most common background for someone on Wall Street. So how do you think your time at law school influenced, first of all, the way you think, but also applied to your career later as a researcher and strategist in the markets?
So, first of all, you would be surprised at how many people on Wall Street have a legal background or legal training. Um, the stat that I remember was 7 years after graduation, half of law school graduates aren't practicing law. But here's a really fascinating thing. And I kind of joke with my business school friends. I think business school teaches you what to think, and law school kind of teaches you how to think. And let me unpack that a little bit. So you have the starting documents, the Constitution, various other legislation, state and federal. And then each time a case comes up, it's a completely different fact pattern. And you have to figure out the classic syllogism. Here's the rule, here's the fact, apply the rule to the fact. That turns out to be really helpful when you're looking at things like markets and companies and investing. And so here's what the market has done historically when A, B, and C has happened. Here's what the results look, here's the range of results. So the first thing that you kind of learn is what are the facts? What are the guiding principles? That's a great thing to learn no matter what field you go into. And then perhaps the most interesting thing, to me anyway, is the concept of moot court. Moot court is second year of school, and you have to argue a case from start to finish. Everybody is given the same legal research, the same case law, the same fact pattern. So it's not like somebody's research skill is going to pull a rabbit out of a hat. You all have the same tools to work with, but here's the tricky part. You don't know which side you're going to be arguing for. And so what you learn is you can't prosecute a case or prosecute a crime if you don't understand how to defend that case or defend that crime. And it teaches you that in life, there are really very few absolutes. There are two sides to everything. And when there are two sides to everything, it makes you consider things from a much more comprehensive perspective. So if you think that stocks are overvalued and they're going to go down, before you make that bet, you should be able to articulate what happens if stocks aren't overvalued? What happens if the economy expands? What happens if there's this policy change or the Federal Reserve does this or consumers do that? And it forces you to not think of the world in binary up or down terms. It makes you think in terms of not just two sides to each issue, but in terms of probabilities. What's the high probability outcome? What's the low probability outcome? What's the big fat middle probability where most unknowns tend to fall? You know, when you think about the bell curve, typically how a lot of schools do grades, the tails, the outliers, those are really rare. Very few F minuses and A pluses. But there's a lot of, C pluses, B minuses. There's a lot of that middle part. Well, the world is like that. You flip on television and everybody is so sure of what's going to happen next. Everything is described in black and white terms. And, one of the things you learn from moot court is there are lots of shades of gray. The world is complicated. Things happen in all sorts of ways for all sorts of reason. And if you grossly oversimplify things, you tend to end up with a false model of the world. And so that was to me my favorite takeaway from law school is to really, we all live in our own little bias bubbles. You have to be able to get out of that. You have to be able to see all sides of the argument, whether it's this stock or that, or recession or no recession, or impeach this judge or president or that. There's multiple sides to everything. Just looking at the world from a very narrow, if we're talking politics, tribal. If we're talking investing, are you a stock guy? Are you a bond guy? Are you an active guy? Are you a pass? Are you an index guy? Are you a value? Are you a growth? Like everybody breaks the world up into these very binary categories. It's not how the world really works.
I've heard a lot that law school teaches you how to think, but I've never really appreciated that specific perspective. And especially, I like that example of moot court. But I want to move on a little bit. So after law school, you went into corporate law for some time, and then you were a trader at what was the predecessor to E-Trade. So take us through your first job on Wall Street all the way to right now, being the chairman, CIO, and co-founder of Ritholtz Wealth Management, kind of your job
So
progression.
sure. So starting out as a trader, the training is kind of modest. Give you a rough overview. They show you how the technology works and kind of throw everybody in the deep end of the pool. If you don't drown, hey, congratulations, you're a trader. And so I spent, I don't know, the first couple of years kind of figuring out why certain sectors or stocks would move, why the whole market moved at a time. This was in the mid 90s when everything was going up. There was a lot of enthusiasm for technology and software, particularly online and internet. And you ended up with a situation where on a trading desk, you have to execute orders for the house, but you also have the opportunity to trade whenever you saw an opportunity came up. And I tried to learn from, you're on a long desk. All these people are mostly guys are on this desk. And I tried to learn from the people I sat next to. And what was fascinating was one month, the guy on my right is making a lot of money, and the guy on my left is losing a ton of money. And then the next week or the next month, suddenly the guy who's losing all that money is making money, and the other guy who is winning is losing. And I tried to figure out, was it their style? What changed? I mean, it seemed almost random. And I kind of eventually stumbled into the world of behavioral finance. I got a book. The first book on Wall Street I ever read was Market Wizards by Jack Schwager. And even though the book talks to bond traders and currency traders and stock investors and all these different areas, it's all about managing risk, controlling your own behavior, and making sure that whatever you're doing squares with reality, that you aren't, sort of stuck in your own little make believe world. And then that was kind of interesting. And then the next book, I don't remember who gave this to me, but a professor up in Cornell named Thomas Gilovich, How We Know What Isn't So. It was one of the first popular culture books on, I want to say behavioral economics, but it hadn't quite gotten there yet. It wasn't until the 2000s that really the mainstream was talking about that. And that forced me to, instead of looking outwards to figure out why people were doing what they were doing, to turn around and look inwards and say, what's going on in my mind, my cognitive processes, the model of the world we all create, my own emotions, biases, etc. Every person has that, and you don't really think about them until you're watching your profit and loss each day, week, month swing, and you're trying to figure out what's going on here. And eventually, I kind of figured out that, oh, this isn't a strategy or a tactic or something I'm doing wrong. My entire operating system is not designed to manage this at all. And that's really fascinating.
And so you eventually started at Ritholtz Wealth Management with Josh Brown in 2013, if I'm correct. And when you started out, you didn't want to deal with the back office, or the reason you didn't start your own wealth management firm is you didn't want to deal with the back office or with the clients. But you agreed that Josh Brown would focus on the back office, the administrative work, and with the clients, and you would do the investment management. So you guys, in turn, built what is now one of the fastest growing wealth management firms in the United States. So I asked this question to you: what makes a great partnership?
So let me just roll back the timeline a little bit. I had met Josh about 2 or 3 years earlier at a conference and immediately recognized him as talented. And he wanted to get away from the sell side to the buy side, meaning management, not sales and brokerage. And the financial crisis had come and gone. I had been fortunate enough, mostly because my mother was a real estate agent and I was looking at the real estate side. So I was able to see that coming. Josh joined me at the firm we were working at prior to the launch of Ritholtz Wealth Management. And people were just throwing a ton of money at me at the time. And, we had a conversation once. He said, do you have any idea how hard it is to raise capital? You're turning this money down. And my answer was, we're not in the right place to manage money. I don't want to put them into house product. I don't want to put these people into a transactional, non-fiduciary sort of situation. It's not in their best interest. So the conversation eventually reached the point where, Barry, you manage the money, decide how it goes, keep it away from the broker dealer side. We'll manage it on the RIA side. And once we get to $100 million, we could leave and launch our own firm. And pretty much that's the genesis. Chris Venn runs the all the advisors in the firm. He was one of the first hires. Michael Batnick is a managing partner at the firm and really is where a lot of the rubber meets the road in terms of being the liaison between the investment committee and the advisors. He's a huge help. What was so important with us, the four of us, when we launched, is everybody more or less gravitated to their strength, and we each did what we did best. And, that was 12 years ago and still going strong.
And there are thousands, maybe tens of thousands of wealth managers out there. What makes Ritholtz Wealth Management different?
So there's a couple of things that makes us different, uh, but there are two in particular that really stand out. One is all of our clients self-select. They all come to us and say, please help me with my asset management. I know that sounds a little odd, but most of the industry is outgoing, meaning smiling and dialing, reaching out for clients, working the circuit, doing what they have to do to raise money. From inception, we had literally a giant, fire hose of people reaching out. So we didn't have to spend a lot of time and effort finding new clients. We got to spend all our time and effort creating informational content. No, the model is very much, here, you could do this yourself. Here's a whole lot of great content and information how to do it yourself. By the way, if 1% or less of you want someone to help you, we're happy to charge you a fee to do it for you. And so that, became the business model. So I think that's a little unusual in Wall Street. But the second thing was what I was hinting at earlier is the behavioral side. We were very conscious. I have been very conscious from the early days of my career, all the mistakes people make, the bad information they consume, the lack of understanding about numeracy, exponential compounding, some just really basic math concepts like framing and denominator blindness. And there's just so many things that we were not built for and that finance is very involved in. The vast majority of human history is adapting to evolving to adapt on a hostile savannah. Humans are soft and squishy and tasty, and we don't have fangs or claws or armor. So we've evolved to adapt to be a cooperative species. And that has created our operating systems, which work great. Humans are all over the planet. We're one of the top 10 species. We're just right behind bacteria, viruses, worms, crabs, mosquitoes, then us. I mean, that's how dominant of all the millions and millions of species over the past few billion years, we've managed to um, take over every corner of the planet, just about. Not quite as much as the worms and the crabs, but pretty close. And so we're all born with this operating system. We all have this wetware. It doesn't always work to our advantage. Understanding that and understanding how to use that in terms of helping clients understand the vicissitudes of the markets, the economy, that stocks go up and down, that there's a challenge in planning long term, and just using all of the knowledge that has been amassed, especially over the past 20, 30 years. I think that's something that's really significant.
And especially in today's age, many students know exactly what they want to do as a career, starting out as early as their early teens or mid teens. And your career has been pretty unconventional as far as it goes in the financial markets world. And you're also a part-time podcast and part-time blogger, and we'll talk about that later. But how important has been trying new roles and seeing what works for you been? And what do you say to those students like me, who think they know exactly what they want to do?
I'm jealous. I wish I knew exactly what I wanted to do when I was your age. I had no idea. And it was definitely a source of stress. Um, I will tell you, I don't think of myself as a part-time anythinger. I think that the writing and blogging, the podcasting, the asset management, they're all sides of the same, I don't know, let's call it dice, not coin, because there's so many different sides. I think in the book, I quote Daniel Boorstin, the Librarian of Congress. I write to figure out what I think. There's something to be said for organizing your thoughts and putting them together in a very logical, coherent, written piece, sharing it publicly, dealing with the sort of response you get from others about it. Um, like I appreciate people challenging the ideas, forcing you to think through what you're saying, to defend certain positions, to reverse certain positions, and say, "Oh, maybe I'm not thinking correctly on this. Maybe I need to adjust my thinking about this." I have found that to be really the writing part to be really helpful. The podcasting part is kind of amusing because I've been podcasting for so long. When I started podcasting, there were really no finance podcasts. I was writing for my first book, Bailout Nation, came out about 15 years ago. And I was writing after that. I was writing for the Washington Post, and Bloomberg came knocking. And when were giving me a tour of the facility, part of the tour was, "Hey, we have these television studios. How do you feel about a TV show?" I was kind of lukewarm, and they're like, "Why not?" I don't feel like I have a whole lot to say every day. Oh, the market went up 0.5%. The market went down 0.5%. It's all hindsight bias. If you can't tell me why the market is going to do this tomorrow, telling me tomorrow afternoon is you're just telling me what happened. And
Yeah.
I remember during the start of the Iraq War, mosque got bombed and oil prices spiked. And the Wall Street Journal headline was, "Oil rises as allies accidentally destroy a mosque." And I'm like, I guess they're saying that those two things are related. By the end of the day, oil prices had reversed and fallen, but the mosque was still destroyed. So the same exact article, but the headline changed. Oil prices fall despite mosque getting bombed. And it kind of was like a light bulb went off, and so they have no idea why these things are happening. It's almost random. And you start researching um, narrative fallacy and the hindsight bias. Hey, after we know how something ended, when you know who won the Masters tournament, when you know how the movie ended, it was the butler who did it, right? I won't spoil White Lotus for anyone who might not have seen it. Wait, what happened with Walter Goggins and Mary Lou? They what? So once it ends, you can't recall what it was like when you didn't know what happened. And so you just rationalize that, oh, this was inevitable, this has to happen. I used to give a presentation not long after the financial crisis called "This is Your Brain on Stocks." And I wanted to demonstrate for people how the various biases that every one of us are afflicted with and are wholly unaware of. So I like to ask an audience back in 2010, 11, 12, how many of you saw the financial crisis coming long in advance? Raise your hand. 2/3 of the hands in the room go up. That's great. Now, everybody put your hands down. Let me ask you that same question differently. How many of you saw this coming and you shorted Lehman and you shorted Bear Stearns and you shorted AIG? Anybody short those companies? No hands go up. All right, forget those companies. How many of you saw the risk to the brokerage and bank stocks, the home builders and the mortgage underwriters? How many of you shorted those sectors? No hands go up. All right, so forget the stocks, forget the sectors. You all saw this giant crisis coming. How many of you shorted the market, bet the entire stock market was going to fall? One or two hands. All right, forget shorting the market. How many of you at least moved out of stocks into bonds and cash? Still, no hands go up. So now let me ask you again, because I reminded you of your actual behavior during that time. How many of you saw the crisis coming, shorted AIG, Lehman, bank stocks, moved out of stocks into bonds, and otherwise, and people kind of are shocked because at the moment, of course, we saw the financial crisis. How could you miss it? It's giant. So once you start to realize how influenced we are by our own software, by our own operating system, it's very challenging to make good decisions without taking that into account. There are lots of different ways you can do that. I'm happy to go over all of them, but be aware there's an entire field called behavioral economics, and it's a grad level course that you can take at a lot of schools that spending 2, 3, 4 years studying that.
And I want to take kind of a step back, talk a little bit about your book. So very recently published a book called How Not to Invest. I have it right here with me, and I took a read before this interview, and I very much recommend it to especially students who are listening to this podcast, who are just testing their feet in the water of the markets and kind of want to understand what to do by learning what not to do. So you focus on 3 categories in the book: bad ideas, bad numbers, and bad behavior. Can you kind of break down those 3 main themes and some of the common mistakes investors make in each theme?
Sure. So let me start out by giving a shout out to Charlie Ellis, who in the 1970s wrote a short paper called The Loser's Game, which 20 years later he expanded into a book called Winning the Loser's Game. And I play tennis. I don't know what your game is.
I do.
So tennis is a perfect example. Tennis is 2 games in one. There's a winner's game and there's a loser's game. The winner's game is how the professionals play, how the 0.01% of all the millions of tennis players in the world, the winner's game win by they hit with power and accuracy. They serve aces. They kiss the line with the ball. They use drop shots that are impossible to hit back. They keep the ball away from their opponent's sweet spot. The professional game is a winner's game because you win games and matches by winning points. But, you and I are not Rafael Nadal and Roger Federer. We're amateurs. Amateurs don't win usually by scoring points. Most of the time, amateurs lose through unforced errors. We double fault on the serve. We hit the ball long. We hit it wide. We hit it into the net. We hit the ball with not enough topspin. It comes right up to the sweet spot of our opponent's swing. And they're able to put the ball where we can't touch it. And so Ellis drew the comparison between investing and tennis. Investing turns out to also be 2 games in one. There's a winner's game and a loser's game. The professionals win by generating alpha. They score returns over and above what the market gives us. Amateurs, which includes most nearly everybody, because even foundations and endowments and institutions, they're still run by people, and they still have the same wetware the rest of us have. We lose by making mistakes. We overtrade. We either have too much risk or not enough risk. We're not aware of taxes. We think we can market time. We think we have the ability to not just pick sectors, but pick stocks. And it turns out that the parallels are so perfect because in tennis, if you're an amateur, as most of us are, just make fewer errors and you do much better. In investing, everybody is trying to hit that next, I'm going to mix metaphors, to hit that next home run, but don't try and hit a home run. Just wait for your pitch, get some wood on the ball, have a good swing. If you, as an amateur, just make fewer decisions, make fewer mistakes, you're just much better off than everybody else who's just making one error after another and hurting themselves. So that's the broad overview. We could drill down into bad ideas, bad numbers, bad behavior. Tell me where you want to go from here.
So I want to focus on bad behavior for right now, and you kind of cite emotional decision making as a part of bad investing. So how can you investors new to markets, mitigate the role of emotion, bias, and human error in their investing?
Sure. So fear and greed is what's notoriously known for driving markets. There's an old joke, there's nothing more infuriating than seeing your idiot neighbor down the street become wealthy, right? So stocks begin to run up. It doesn't matter what it is. It could have been pets.com in the 90s. It could have been Bitcoin last decade, Apple and Amazon before that, Nvidia now. And it doesn't matter. You missed it. You're not participating. And there's FOMO. FOMO is nothing more than greed by another name. And so you jump in, you chase the hot stock, and that rarely seems to work. So your fight or flight response is one of those things that um, your amygdala is part of your limbic system. It's where all the fear and greed and reward and all the pleasure centers are. And I had a really interesting conversation with Bill Bernstein, former neurologist turned investor, and he says I love this quote, which is in the book. Your limbic system is going to be what determines your success as an investor. It's what controls fight or flight, how you react emotionally, and either you get your limbic system under control as an investor or you don't. Those who fail to get their limbic system under control will die poor. Like, that's a really heavy statement from a doctor. And so emotionality, the book I refer to is Danny Kahneman's Thinking Fast and Slow. Your thinking fast system is that's your amygdala, that's your adrenal system. That's the reacting to a threat. And so I have to fight or flight. I have to either run away or stand my ground and do battle. And your heart starts to pump. You begin breathing quickly. There's a bias towards making a decision, any decision. Doesn't matter if it's good or bad. Throw a virgin in the volcano. It doesn't matter. Whatever we have to do to appease the gods. And so there's this tendency to have these immediate reactions to, look, you have a portfolio that's worth X. Suddenly it's worth 10% less than X. Your body reacts to that. That's an existential threat. Oh my God, how am I going to retire? How am I going to pay for kids' college? What am I going to do? Like, all those questions come up. And so your emotions bubble up and you end up making bad decisions. One of my favorite bad decisions in the book um, points to a study that shows that when people panic out of the market during a crash, and this study was done after the 0809 crash, 31% of them never return to equities. So think about that. You have this horrible market crash in 0809, equities go on sale, 57% off, and people say, this stock thing isn't for me. And so they miss one of the greatest decades in market history. Some of it has to do with that 57% drop, but a lot of it has to do with with the fact that you had this giant monetary stimulus, bonds were yielding nothing, money had nowhere to go but into stocks. But because people are embarrassed that they either sold at the wrong time or they're afraid I sold, as soon as I go back in, the market's going to go down another 30%. I'm going to look like an idiot. There's a lot of hubris, there's a lot of ego built into these bad decisions. Um, I think that that's a key part. So that's the thinking fast. The thinking slow is being logical and measured and deductive and thinking second and third order decisions, not just responding. It's not speed chess. It's I have to think this out three, four, five moves ahead. Most people who are in panic mode don't really get a chance to do that.
And I want to kind of shift a little bit over to the bad ideas part of it. So you talk about kind of media madness is what you phrase it as, but constantly consuming financial media and also paying attention to people's perspectives. And when in the end, nobody really knows anything. So how can people re-engineer their media consumption to make it more useful to their needs? Because you wrote in the book, but I kind of want you to phrase it here yourself. And also, what is the cost of constantly listening to financial media 24/7 all the time?
Right. It's so I am both a big consumer of media and a big producer of media. I'm on both sides of the mic. And I kind of learned early on as a trader, I had to be careful what I read in the morning on the way to work because whatever the last voice in my head was affected my outlook and affected my trading. So I started saving the articles I wanted to read for the ride home. So I wasn't, I'm okay looking at it when I'm a little more objective and the trading day is over. Each day to me is a fresh reboot. You start in the morning, you start fresh. Um, but you get these moments of self-doubt and moments of concern, and it often interferes with your own process. So that was the first kind of lesson I learned, which was, hey, you got to be aware of what's coming in. Anybody who's a nutritionist or any of the professional athletes, they all have people who tell them what you put into your body is going to affect how your body can perform. Well, what you put into your brain is going to affect what you perceive, how you see the world, and you have to be really selective about that. A lot of what passes for media is and for legitimate news, there's a lot of speculation, there's a lot of opinion mongering, there's a lot of chin stroking. I think, I feel, I hope. That's not what I'm reading the media for. You really want people who are bringing you something that's value added and that is worthwhile. It's Laszlo Barini's shop used to do this thing where they would print each quarter and each year all the headlines from the previous year's newspapers, like the relevant financial headlines. And they're fascinating to look at when you know how the movie ended. Because even though they are more or less accurate, um, what comes out after the fact is the um, is the emotionality of the moment. They may have gotten it more or less right, but they very much get wrong, or they're just reflecting the gestalt of the moment, how crazy things are. Thinking of the first quarter of 2020 during the pandemic. A lot of the headlines were, in hindsight, I guess, technically accurate, but just so emotional and filled with noise that it wasn't that they weren't useful, they were um, harmful to investors. So that's one thing. So my recommendation to people is whoever you're following, it doesn't matter if it's Instagram, TikTok, Wall Street Journal, Washington Post, writers, it makes no difference. You can't just assume whatever you're reading is for you. You can't assume that they're writing for you saving for college, you saving for to buy a house, you saving for um, anything other than they're trying to draw your attention. what they sell, I always used to like to ask people, what does media sell? And people usually say advertising, but the correct answer is no, advertisers, the buyers. The media sells you as the audience. They sell your attention, they sell your time, and now these days you can cross-reference it with your credit score, your browsing history. They sell all of these other things, and you're the audience. And so it's safe to say that most of the media out there does not have your best interest at heart. They're a business, they're selling a product, and they really don't care about your retirement. Um, the same is true for everybody who comes on TV and everybody who goes on the radio. They have a product they're selling. It's not your secure retirement. It's not you saving for the first down payment of your house. It's um it's a very different thing. And I think generally speaking, when I was younger, I used to listen to I used to listen to um, conference calls with CEOs and others, and um, and I would believe everything they said. I was a little naive. I was a little gullible, and eventually, I found myself saying, "I got to stop believing all this crap because they don't care about my personal um, retirement. They care about meeting their quarter and getting people to buy their product and their stock." And that was like a big breakthrough to kind of figure that out. So now I want to follow people who've lived through a few cycles, who have a process that's defendable, that they don't run around with their hair on fire. They don't run around freaking out every time something bad happens, and that their approach is, you know, intelligent and value add. And while there are lots of people like that, numerically, statistically, they're the minority of people who are out there in the media.
And as a young podcast host, of course, you put out media, I put out media, not at the scale that you do, but I get the question a lot of what is kind of the most valuable lesson or the biggest lesson you've heard from interviewing your guests in your podcast. So I kind of want to push that question to you. What do you think has been the kind of biggest overarching lesson or idea that you've learned and you found the most interesting during your time interviewing people in your
Sure.
podcast?
So I ask every guest the same last five questions. What are you watching? Who are your mentors? What's your favorite books? What are you reading now? I ask, what advice would you give to someone who wants to go into your field who's just coming out of college? There's a giant range of that. But the last question is probably the most thoughtful, which is, what do you know now that would have been useful when you were first starting out? Like, I don't mean buy Nvidia at 10 cents. I mean, what have you learned that, gee, it would have been nice to have learned that earlier? And I get a lot of the same answers. They fall into a couple of big groups. Um, so I'm going to give you three short ones. The first one is the impact of luck. And when I first started hearing this from billionaires and Nobel laureates and CEOs, part of me is like, all right, great. They're blowing smoke up your butt. But I've heard it from enough people who have been really sincere about it. I mean, Howard Marks of Oak Tree Capital once said, come on, I push back a little bit. I'm like, come on, Howard, it can't just be luck. You have to be smart. You have to work hard. And he said, I think it was Columbia. I went to business school at Columbia. Everybody I worked with was every bit as hardworking, every bit as smart as me, some harder working and some smarter. Sometimes you just get lucky. You're in the right place at the right time. An opportunity comes along that doesn't get offered to everybody. So recognizing the role of luck is one thing that I thought was really impressive. Related, but a flip side of that is having humility and saying, I don't know. Hey, maybe I'm not an expert in this, this, and this. I have to go learn about that. So that was, Wall Street has this very big fake it till you make it philosophy. When you look back at the training courses that the big finance shops used to offer, It was like a week. It was like a whole year's training course. The first week was modern portfolio theory and how to build a bond ladder and asset allocation. Then the next 51 weeks were sales training. And a big part of sales training is self-confidence and smiling and listening to the client and, projecting confidence. That leads to a lot of bullshit. That leads to a lot of fake it till you make it. And you kind of learn that that becomes dangerous as you develop more and more responsibility and are managing more and more money. You have to say, I don't know. Hey, how come nobody has thought of doing this stick pin way of taking blood through, that Theranos had created? How come everybody has been drawing it from a vein? We know stick pin to check glucose and blood sugar. How come no one's done this before? Had someone asked that question, they would have known because the process of doing it um, damages the sample, leads to a lot of other stuff happening. There's an advantage to venal blood versus interstitial blood, which is why none of the medical technology, biotech, other health related hedge funds and venture capital funds invested in Theranos. Um, Nobody was willing to say, I don't understand this. I don't know. And $10 billion of capital went, down the drain. We saw that with Enron. We see it time and again. When people are afraid or embarrassed to say, I don't know, bad things happen. So I think having a little humility and recognizing that you can't forget knowing the future, you can't possibly know the present. And then the last thing, I think the last thing, which is a little specific to me, I spent the first, I don't know, 20 years of my career kind of as a lone wolf. You're alone on a trading desk, you're alone as a strategist, you're alone as an analyst. And over the past 15 years is really the first time I've been part of an ensemble practice, part of a team. And I wish I had figured this out earlier because suddenly, oh, I don't have to do the things I don't want to do, and I get to focus on what I really want to do. And it being part of a team, having colleagues you can rely on, being able to spend your time and energy on what you do best. Like it's a joke, but it's true. When we first launched the firm, I'm doing the payroll, Josh is doing the healthcare. You don't want to work at a company where Barry's doing payroll, Josh doing healthcare. You just don't. It's not a good situation. So um the dog who was just begging to go in is now banging on the door to come out, but he's gonna have to sit there. So really being part of a team really is a big change over the past 10, 12 years. I wish I would have figured that out sooner.
And two final questions, and I can really relate to. I love the fact that you have 5 questions you ask every guest. I have one question I ask every guest at the end, and we'll get to that after this question. But I've started asking this question more and more. But what does a day in the life of Barry Ritholtz look like, and what information do you consume on a daily basis?
So every day is a little different. I record the podcast on Tuesday, which means Monday I'm writing the questions. Wednesday or Thursday I'm ordering it, so it's a little different. I'm in the city a couple of days a week for. I do my podcast in person. I do another show for Bloomberg that can be remote. On Mondays, I'm usually writing up some commentary or notes to post, to share with clients, to do whatever. Friday is a lot of meetings, a lot of calls. It varies day to day. It's not the same every day. Um, I consume a lot of media, but you know, I mentioned reading stuff on the way home when I was on the desk. That became a daily reading list, which surprisingly got shared around the office and then faxed and then emailed and eventually put online. So, and I've been doing that for about 25 years. And I found that you get enough reps in, you do it enough. I could start reading something, and in a sentence or two, I know if I want, it's worth it to keep reading. Like that's a skill that took a long time to develop. And when I find something that's good, I'll take a note of who the author is. And if I start to see that name in the same feeling, they get added to my sort of all-star team. Um, but I'll open about 40 tabs on most mornings, just quickly scan all the major media from the Wall Street Journal, the New York Times, Washington Post, the FT, the Economist, the Atlantic. I'm just really quickly getting a sense of what the media is saying. At the same time, I'm paying attention to the Wall Street research that I like from people who have earned my trust, trying to see what's the public getting fed that's right or wrong, or slanted in a way that's helpful or not helpful. I don't do this every day. I do find that at a certain point, it gets to be a little, tedious. A lot, very often it's what there's an old joke. There are years where nothing happens and days where decades occur, and it sort of feels like the past month has been like every day has been a year. And so you go through these periods of calm and volatility, being able to see through the noise, being able to kind of ignore the worst elements in the media. My favorite Twitter feed is a thing called TikTok Investors. I write about it in the book. And this person just finds the worst advice on social media. Sometimes it's Instagram, sometimes it's TikTok, sometimes it's Twitter. In the old days, every town had a radio station and a newspaper. There were the three broadcast channels, a couple of big newspapers and magazines, and there were guardrails and there were editors. And if I wrote something in 1967 that someone disagreed with, and they would have to take the time to write a letter to the editor and mail it, and eventually the editors go through a big stack of mail, and oh, this seems like an interesting piece, and 2 weeks later it's published on page C17. Nobody cared, because not that model had its own flaws. The current model, where you have algorithmic social media rewarding the loudest, most clickbait type of voices, that has its own downside. And the guardrails are gone. I sometimes have a hard time explaining to some of the younger guys in my office, why are you getting angry about some egg who's been on Twitter since February 2025 and has 7 followers? Their total qualification for criticizing your work is that they paid somebody $19.99 a month for an internet access. That doesn't mean they're qualified. You got to develop a thicker skin, and you have to be aware that. So I sometimes will get into these amusing disagreements with Cliff Asness, who's a brilliant hedge fund manager, runs AQR, quant, really smart guy. I like him. I think he likes me. Every now and then he kicks me in the ass and says, "No, you're wrong, and here's why." So I'll go back and forth with him, and sometimes he convinces me. Occasionally I convince him. Sometimes it's just a draw. And the ability, when someone like him, who was Eugene Fama's research assistant, Fama won the Nobel Prize way back when, and Cliff has just been a brilliant investor and creator of research that has moved our understanding about what drives markets forward. Cliff has the right to correct and criticize me whenever he wants, and I'm receptive to that because of his track record and his history. But some random yuts on, Facebook or Twitter, I really don't care. And I think people need to develop that attitude. Who are you listening to and why? Who are you paying attention to? Not just social media criticism, but what's going on in the mass media, what's going on television, what are you reading and paying attention to, and what's the impact of that?
And our final question, which we ask every guest, which is happens to be similar to one of your final questions, but if you were to give one piece of career or life advice to a high schooler today, what would it be?
Constantly build your skill stack. And I'm gonna unpack that really briefly. So when I first started writing online was back in the 90s and it was GeoCities and I had to teach myself HTML. And so I'm literally coding in HTML. It'd take me, 10 minutes to write something and then an hour to post it because you have all the literally coding. And that was an interesting skill to develop. And I wish I would have developed some more coding skills like Python, or R. Go down the list of different things you can learn how to do. Like my Excel skills are pretty good. They're not great. I mean, not compared to people I know who just make Excel dance and sing. And so I would say, one of the things that you learn from both college and law school. So I went to law school in New York City. I had a buddy who went to law school at Berkeley. I know people who went to Stanford, to Cornell, to NYU, to Columbia. We all got the exact same course syllabus. We all had to read the same books, the same casework. And it turns out that it doesn't matter where you go to school, you essentially become an autodidact. You teach yourself first how to learn, and then you teach yourself everything. And so the one thing I would tell you is don't assume that once you're out of school, learning ends. Once you're out of school, learning just begins. You're really just first learning how to build those skills. And I would tell you just keep building those skills constantly. Develop all the tools you need on a regular basis, and don't think twice about, hey, if I have to go back and take this class or learn how to do this, I'm very happy to do that.
Thank you, Barry, for coming on. I really appreciate it. This has been a great conversation. I learned a lot, and I hope you enjoyed it.
Well,
Thank you.
thank you so much for having me, Amir. I really appreciate it. I'm fascinated to see how many people are hosting podcasts today. When Bloomberg first offered me a TV show, I said no, I would rather host a podcast. What's that? Well, I'd like to sit and have conversations with intelligent, accomplished people, long form. What do you mean? Like 8 minutes, 10 minutes? No, like 2 hours. When everybody finished laughing, they said, tell you what, get us 32 minutes of good content plus traffic, news, sports, weather, commercials. That's an hour of radio. And so to me, it's been the most fun I have all week. I get to sit down with interesting people and ask them questions. Um, I'm glad to see the next generation of podcasting is in good hands.